Hi, everyone, and welcome back to Financial Market Insights for Traders. I'm Sophia, and today we're diving deep into one of the most talked about macro stories in global markets right now: India's growth trajectory and what it really means for investors. This is not just another high level overview. We're going to unpack the full picture: the structural drivers, the opportunities, the risks, and most importantly, how to think about India from a macro investing perspective. Because here's the truth: India is not a simple growth story, it's a layered, evolving, sometimes contradictory macro narrative. And that's exactly what makes it interesting. Let's start with the big picture. India has positioned itself as one of the fastest growing major economies in the world. We're seeing consistent GDP growth in the range of roughly 6.5% to 7.5%, and that's not just a post pandemic rebound. This is being driven by deeper structural changes. What makes India stand out is that its growth is largely powered by domestic demand. Unlike export heavy economies, India relies heavily on internal consumption. That gives it a certain level of resilience when global conditions weaken. And this domestic engine is being fueled by a combination of rising incomes, urbanization, and a steadily expanding middle class. Millions of people are moving into income brackets where they can spend more, invest more, and participate more actively in the economy. From a macro investing standpoint, this matters because it means growth is not entirely dependent on external demand cycles. Now, let's go a level deeper into what's actually driving this growth. The first major pillar is demographics. India has a young population. The median age is significantly lower than in most developed economies. That translates into a growing workforce and long-term consumption potential. But demographics alone don't guarantee growth. The real question is whether the economy can create enough jobs and provide the right skills. If it does, this becomes a powerful tailwind. If it doesn't, it becomes a structural risk. The second driver is policy reform. Over the past decade, India has introduced several reforms that have improved efficiency and transparency. The goods and services tax simplified the tax system. The insolvency and bankruptcy code strengthened credit discipline. And digital identity systems have expanded access to financial services. These are not headline-grabbing changes on a daily basis, but over time, they reshape how the economy functions. They make it easier to do business, improve capital allocation, and attract investment. Next, we have infrastructure. And this is a big one. The government has been aggressively increasing capital expenditure. We're talking about investments in roads, railways, ports, and logistics networks. This kind of spending has a multiplier effect. It creates jobs in the short term, but more importantly, it improves productivity over the long term. It reduces transportation costs, improves connectivity, and makes private investment more viable. For macro investors, infrastructure is not just a sector. It's a foundation that supports multiple sectors at once. Another major shift we're seeing is the digital transformation of the economy. India has leapfrogged in terms of digital adoption. With widespread mobile usage and low data costs, digital payments have exploded. Fintech platforms have grown rapidly, and more people are entering the financial system. This has led to something very important: the financialization of savings. Traditionally, a large portion of savings in India went into physical assets like gold or real estate. That is changing. More money is now flowing into equities, mutual funds, and financial instruments. For markets, this creates a more stable and diversified investor base. Now let's talk about manufacturing and India's position globally. There's a clear push to turn India into a manufacturing hub. This is partly driven by global supply chain shifts. Companies are looking to diversify away from concentrated production bases. India is trying to capture that opportunity through initiatives that support domestic manufacturing in sectors like electronics, pharmaceuticals, and renewable energy. It's still early. India is not yet at the scale of some established manufacturing economies, but the direction is important. Over time, this could significantly change the structure of the economy. So, with all of that in mind, where are the actual opportunities? Let's start with the financial sector. Banks and financial institutions are in a much stronger position than they were a decade ago. Balance sheets are healthier, Non-performing assets have come down, and credit growth is picking up. As incomes rise and the economy formalizes, demand for loans, insurance, and investment products continues to grow. This makes financials a core theme in any India-focused macro strategy. Then there's consumption. But this is not just about basic consumption anymore. What we're seeing is an upgrade cycle. People are spending more on higher quality products, better brands, and discretionary items. Urban demand is particularly strong, and this creates opportunities across sectors like retail, travel, automobiles, and consumer goods. Another major theme is the energy transition. India is investing heavily in renewable energy. There are ambitious targets for solar and wind capacity, along with growing interest in green hydrogen and electric vehicles. This is not just about sustainability. It's also about reducing dependence on imported energy over time. For investors, it opens up long-term opportunities across multiple industries. Capital markets are also evolving. Retail participation has increased significantly. Regular inflows through systematic investment plans are providing a steady base for the markets. This reduces reliance on foreign institutional investors to some extent. It also adds stability during periods of global volatility. Now, let's shift to the other side of the story, the risks, because no macro story is complete without them. One of the biggest risks for India is its dependence on imported energy. Oil prices matter a lot. When oil prices rise, it pushes up inflation, widens the trade deficit, and puts pressure on the currency. This is a key variable that macro investors need to watch closely. Another concern is valuations. Indian equity markets often trade at a premium compared to other emerging markets. That premium reflects strong growth expectations, but it also means there is less margin for error. If earnings growth slows or global conditions tighten, markets can correct. Then there's the issue of employment. Despite strong GDP growth, job creation has not always kept pace. A significant portion of the workforce is still in informal employment. This creates challenges around income stability and consumption growth. It also raises questions about how inclusive the growth story really is. External risks are also important. India is integrated into the global financial system. That means it is affected by global interest rates, capital flows, and investor sentiment. When global liquidity tightens, capital can flow out of emerging markets, including India. This can lead to currency volatility and market pressure. And finally, there's execution risk. Policy direction has been positive, but implementation is key. Delays in infrastructure projects, regulatory uncertainty, or shifts in policy can affect investor confidence. So, how do you navigate all of this? The first step is to recognize that India is not a straight line story. It's cyclical. There will be periods of strong growth and periods of adjustment. Focus on long-term structural trends rather than short-term noise. Diversify across sectors. Pay attention to macro indicators like inflation, oil prices, and fiscal policy. And importantly, use tools that help you track and respond to these changes effectively. If you're looking for a platform that's built for that, something that's intuitive, fast, and designed with traders in mind, you can check out this platform here at crystalbellmarkets.com/platform. It's designed to help you stay on top of market movements and macro trends without unnecessary complexity. And if you're still building your understanding of macro investing, I'd strongly suggest learning continuously. A great place to start is by listening to structured, beginner-friendly discussions that break down complex topics into something practical. You can explore podcasts on trading, investing, macro, and financial markets here at rss.com/podcast/crystalbellmarkets. To wrap this up, India's macro growth story is one of the most compelling narratives in global markets today. It offers strong long-term potential, multiple structural drivers, and increasing global relevance. But it also requires careful analysis, awareness of risks, and a disciplined approach. India macro investing is not about chasing headlines. It's about understanding the balance between opportunity and risk and positioning yourself accordingly. And that's what makes it such an important story to follow. Thanks for listening, and I'll see you in the next episode of Financial Market Insights for Traders.